One of the key questions for investors in 2026 is what the Fed will do with interest rates, not to mention who will be the next chair. For more on both fronts, let's welcome in Robert Kaplan. He's the former Dallas Fed president, now vice chairman at Goldman Sachs. It's always good to see you in person. Welcome back.
Good to see you, sir.
All right, let's start with the meeting that just ended. Would you have voted for a cut?
I probably, on the margin, would have argued against a cut. But
really?
Yes.
Why?
I think we're going to head into a firming in 2026 due to regulatory relief, tax benefits, tax refunds, continuation of the AI boom. And I think a lot of the weakness we've recently seen in the job market, it's a little bit of tariffs on small business, but it's the shutdown. It was going to have a negative effect. The shutdown's now over. And I'm worried that we're now at neutral. Do you want to be at neutral when inflation's running above target?
So when you say firming, you're talking about inflation firming further from here?
I think the GDP growth is going to firm. I think inflation may be sticky in the first half of the year, but we'll have to see. But the way I would handle this is my attitude, once the meeting is over, decision's made, now the debate is what we do from here. And I need to see either a deterioration in labor or an improvement in inflation in order to act.
So you wouldn't be one of those who would be willing to run it hot, so to speak, and protect against the downside in labor, like a Waller, for example, who told Steve Leisman today, the labor market says you can cut again.
Yeah. So, yeah, I think we bought our insurance. My attitude would be we just did 75 basis points. We more than bought our insurance against a cyclical slowing. I think a lot of the weakness in labor is structural. Tariffs are hurting small business disproportionately. Anticipation of AI is a structural issue. And I think we bought enough insurance, and we need to make sure we haven't been at target on inflation for now 4 years. And I want to make sure we get back down to target.
So do you not believe that 4.6 on the unemployment rate is legit? You think it's skewed?
It's a little bit for two reasons. Again, we just had a shutdown, and you got this jump in labor supply. I have a feeling over the next few months it would not shock me if that jump in labor supply gets revised down. I don't think you're going to see a persistent jump in labor supply.
What do you make of the dissents, the divided nature of the Fed? You, in many ways, are representative of what we're seeing and hearing from the chair that's actually taking place in the room. How does that resolve itself?
So the reason the divide got more accentuated is they were getting close to neutral. At 4.25, 4.5, you can debate it, but I'm more calm. I think neutral is in the range of 3.5 to 3.75. 2.75% inflation, plus 0.75 to 1% real. And the reason the tension increased as we got to neutral is inflation's running above target. Do I really want to be at neutral? I think it may turn out to be fine, but I think that's the tension. I think that tension now is behind us in that they did it. Now the question is, what do they do from here? But if I was against it in December, I certainly don't want to see any more. I want to see some evidence that inflation's improving, and we may get it, but I want to see it.
But the risks are still two-sided. You could wait to see what happens with inflation, but the labor market takes a turn for the worse, and it might be too late to deal with it. I mean, at some point, the market might be worried about a mistake.
So this is where you have a good debate, and I think it's healthy. Chris Waller is arguing he's more worried about weakness. I would argue we just had a shutdown. The shutdown's now reversed. We've got big tax refunds and tax incentives going into next year. We still have the AI productivity boom, and I think we bought enough insurance, but that's a good thing that you have that debate.